Losing $100 hurts more than winning $200 feels good. This is not a feeling, this is neuroscience. I hold a lost coin and a gained coin. They are identical, but one weighs twice as much. The numbers are the same. The pain is not. And this asymmetry is quietly destroying your portfolio. The ratio is 2 to 1. Losing always hurts twice as much. In 1979, two psychologists changed everything we knew about human decisions. Kahneman and Amos Tversky published prospect theory. Kahneman won the Nobel Prize for it. Your brain does not process gains and losses equally. The loss side burns far more intensely. Watch the same investor win $100, then lose $100. This asymmetry is not a personality flaw. It is hardwired into every human brain. Your ancestors survived by treating every potential loss as a life or death situation. That same ancient brain is now making your investment decisions. A caveman fearing an empty food basket and a modern investor fearing a red portfolio, identical brain response. Your brain cannot tell the difference between a tiger and a stock loss. And that is exactly why you need to hear this. The investor who just won feels a small lift. The investor who just lost feels devastation. Same dollar amount, completely different emotional reality. The emotional response to gains peaks quickly. The response to losses drops sharply and keeps dropping. The valley of loss is far deeper than the peak of gain. A 50% gain followed by a 50% loss does not return you to zero. If you lose 50%, you need 100% gain just to break even. The math is brutal. Most investors never think about this until it is too late. Start at 100, drop to 50. The distance back is twice as far as the fall. The investor stares at the sell button. His hand does not move. He knows he should sell. He cannot do it. The stock has been falling for months. He holds it with eyes closed, still hoping. 1 year passes, 2 years, 3 years, 4 years, still holding. 4 years of waiting for a stock that never came back. This pattern has a name, the disposition effect. Sell winners too early, hold losers too long, both driven by the same bias. Investors consistently do the exact opposite of what they should do. They sell rising stocks to lock in the comfortable feeling of a gain. They hold falling stocks to avoid the painful feeling of admitting a loss. The correct strategy is the reverse. Hold your winners, cut your losers. The wrong strategy feels emotionally comfortable. The right strategy feels emotionally painful. That is the trap. Your brain is steering you toward comfort and away from returns. A casino gambler doubling down. A stock investor holding a loser for years. Same brain. Same bias. Loss aversion does not stay in the stock market. It shows up everywhere money is involved. Sunk cost and loss aversion overlap. Together, they are the most expensive trap in personal finance. When both are active at the same time, rational decision-making becomes nearly impossible. The homeowner who bought at peak refuses to sell even as the price drops further. Every month he waits, the loss grows larger. But selling means making the loss real. The businessman keeps pouring money into a failing company because stopping means admitting failure. He is not investing in the future. He is paying to avoid the pain of the past. The insurance industry is built entirely on loss aversion. The premium grows. The insurance company grows. Loss aversion funds both. Investors who learn to override loss aversion outperform by 2 to 3% annually. 2 to 3% every year compounded over decades is the difference between comfort and wealth. Meditation and emotional awareness during market drops can quiet the loss aversion response over time. The brain is not fixed. With the right tools, it can be retrained. The most powerful tool is pre-commitment. Set your rules before the market opens. Write down your rules when you are calm, then follow them when you are not. Automatic stop-loss orders remove the emotional decision entirely. The circuit breaker trips at a predetermined price. No emotion required. Sell if down, 15%. Never sell winners before 1 year. Rebalance every January. These rules exist to protect you from yourself at your worst moment. Zooming out is one of the most powerful things an investor can do. The telescope reveals what the microscope hides. A long, beautiful, upward trend. The investor who checks daily experiences far more emotional pain than the one who checks annually. The less you check, the better your decisions and the higher your returns. Investors who checked their portfolios less frequently made significantly better decisions over time. This is not opinion. Multiple peer-reviewed studies have confirmed this finding. Turn off your stock market notifications. Every alert is a loss aversion trigger. Each notification removed is one less emotional landmine between you and rational decision-making. In a 20-year chart, the short-term losses you agonized over are completely invisible. A longer time horizon is the simplest cure for loss aversion. Instead of thinking I lost $100 today, think my long-term strategy is still intact. The reframe is not denial. It is accuracy. Warren Buffett has watched his portfolio drop by billions multiple times. He has never panic sold. That is not luck. That is decades of trained, disciplined response to loss aversion. Most people keep a wrong item rather than return it. The return feels like a loss. Small, everyday decisions reveal the same bias that drives billion-dollar investment mistakes. You value what you own more than what you do not own, even when they are identical. This is the endowment effect, the cousin of loss aversion that makes selling anything feel painful. In the famous mug experiment, people demanded twice as much to sell a mug as others would pay to buy it. Same mug, completely different valuations. Loss aversion at work. In salary negotiations, candidates accept less than they deserve to avoid the risk of losing the offer. Loss aversion costs them not just today, but every year for the rest of their career. Staying in the wrong job for years because leaving feels like losing security and certainty. Loss aversion chains people to situations they should have left long ago. The antidote is focusing on process over outcome. Judge your decisions by their quality, not their results. A good decision can have a bad outcome. A bad decision can have a good outcome. Process wins long term, pre-commit, zoom out, check less, reframe the loss. These 4 habits change everything. They do not eliminate the pain, they stop the pain from making your decisions for you. The pain of losing is real, but it is lying to you about what you should do next. Do not let a feeling that evolved for physical survival make your financial decisions. Next week, the sunk cost fallacy. Why people keep pouring money into things that are already lost. And why stopping feels more painful than continuing, even when continuing makes no rational sense. Subscribe. Your brain is not your enemy. It just needs better rules. I am the honest dollar, and I have been lost in every way imaginable. The investors who learned these rules held on to me a little longer. Your brain is not your enemy. It just needs better rules.